Hello everyone, welcome back to Rise Finance. In today's video, we are going to talk about efficient way to select dividend stocks. Let's check it out. In the world of passive income, there's nothing better than dividend growth stocks that provide dividends consistently and keep them rising regularly. Such stocks also keep appreciating at the same time. So you see both your portfolio value rising and getting nice dividends on the side. All that one has to do is buy them and just hold them. These stocks will work for you whether you are at work or busy spending your time in ways best suited for you. Dividends are profits that the companies would like to share with their investors, in a way, thanking them for holding on to their shares. We are currently living in an environment where inflation has been growing rapidly. Inflation is an increase in prices for goods and services that we commonly use. The most recent inflation numbers showed an increase of 7.5%, which is the highest in the last 40 years. Dividends help hedge against inflation. Let us look at this article from Fidelity emphasizing the importance of dividends. Dividends aren't just nice to have, they're essential to the stock market's return, accounting for approximately 40% of overall stock market returns since 1930. During periods of high inflation, stocks that increased their dividends the most considerably outperformed the broad market on average. Dividend paying stocks regular scheduled payments also may help to reduce the volatility of a stock's total return. And if we scroll further, we can see this graph that shows how much price appreciation and dividends play a role in the stock market. So as we can see here, the portion highlighted in blue is the dividend and the green is the price appreciation. So as we see here, dividends account for about 40% of the total stock market return over time. Let us now look at all the factors that need to be considered while evaluating dividend stocks. The first is payment history. This shows how long the company has been paying their dividends. We don't want those that have just started paying dividends and not sure if they can keep up paying them for long into the future. This is where we quickly look at few terms used to describe dividend paying companies. The first is dividend kings. These are best in class dividend paying companies who have been paying dividends and raising them consistently for over 50 years. There are 39 dividend kings as of January 2022. Few dividend king examples are Procter& Gamble, 3M, Johnson& Johnson, Coca-Cola. Then we have dividend aristocrats. These companies are part of the S&P 500 index and have been increasing their dividends for more than 25 years. So there is an overlap between dividend kings and dividend aristocrats. So few of the dividend aristocrats are also dividend kings, like Procter& Gamble, Johnson& Johnson, Target, Coca-Cola, etc. Dividend kings and aristocrats give investors confidence that they can raise their dividends even during volatile downturns. They are reliable and are industry leaders and less volatile. There are 66 dividend aristocrats as of January 2022. After the kings and aristocrats, we have dividend champions, which are similar to the aristocrats, but unlike them, they need not be part of the S&P 500 index. There are 129 dividend champions as of January 2022. Then we have dividend contenders, which are those that have raised the dividends for more than 10 years but less than 25 years. There are currently 302 dividend contenders as of January 2022. And at last, we have dividend challengers, which are those companies that have increased their dividends for less than 10 years. There are 347 dividend challengers as of January 2022. The next important factor while selecting dividend stocks is yield. This is the ratio that tells you how much the company pays out in dividends each year relative to its stock price. For example, if a company has a $20 share price and pays a dividend of $1 per year, its dividend yield would be 5%. When we look at this chart, S&P 500 has a yield of 1.27%. I look for companies that have a yield at least higher than the S&P 500, of course, alongside other factors. Now, high yields should not be a factor to pick dividend stocks because high yields means the stock price has decreased considerably, which means you would have to dig into the stock deeper to understand if there is really any issue for the reduction in share price. A company like Johnson& Johnson pays 2.53% yield, while Verizon pays 4.8% yield. The next important factor is to see the 5-year dividend growth rate. This is the average rate at which the company has raised its dividend over the past 5 years. An ideal number for this should be at least more than the current inflation rate so that the dividends can retain their value. I look for companies that have rate more than 10% alongside other factors. A company like Broadcom has a massive dividend growth rate of almost 43% over the past 5 years, while Bank of America has the rate of almost 26%. The next factor to look out is payout ratio. This is the ratio of the total amount of dividends paid out to shareholders relative to the net income of that company. It is a percentage of earnings paid to the shareholders via dividends. So, say a company makes $10 million in profits and pays $5 million in dividends, then their payout ratio is 50%. This means the company, even after paying 50% of its income to the investors, has 50% still left to reinvest in their business. Companies having high payout ratio do not have enough left to grow their business, so their future dividend paying potential may be questionable. An ideal payout ratio should be anywhere between 30 to 55%. 55 to 75% is considered high, and anything over 75% is very high. But there is an exception to this. There are companies called real estate investment trusts which own, operate, or finance income generating real estate. By law, such companies have to distribute a minimum of 90% of the taxable income in the form of shareholder dividends each year. An example of a REIT company is realty income. The last factor is PE ratio. It is defined as a company's share price with its earnings per share. I generally look out for companies that have a PE ratio less than that of the S&P 500. So currently, as you see in this chart, the S&P 500 has a PE ratio of 24.56. In the next video, I will discuss what I think is an ideal starter dividend stock portfolio for a beginner investor. We will look at all the factors we discussed in this video and see how they apply to the stocks selected. I hope this video has been helpful for you in understanding the nuances of how to pick dividend growth stocks. Thanks for watching. Please like and subscribe to my channel to keep informed about all such informative videos in the future. I am not a financial advisor, and all the content you would see in this channel is for educational and entertainment purposes only. Everyone should do their own due diligence before investing their hard earned money. Thanks for watching again. See you in the next video. Bye.